There's three main things that I look for when I analyze the market. This is a great question. Thanks for asking. So firstly, the first thing that you want to look at is the stock or is the market up too high or is it too low? So what happens is when you have long-term investors who are in the market, if something's up too high and they're in it, they want to sell it because they most likely bought it lower and now they're at a profit area. And now there's a higher chance for people to take profits when it's too high, and which can cause the market or the stock to drop. Now, if something's too low, then people look at it like long-term investors and other big buyers. They look at it and say, okay, this is a great opportunity to buy because the market is low. I want to get in now because it's cheap. It's a good price. The next thing I look for, because I'm a chart reader specifically, I like to look at supply and demand zones. Now, a supply zone means a strong selling area. A demand zone means a strong buying area. So now we can assume that if price came to an area in the past and it sold off drastically, we can assume that something similar can happen in the future. Obviously, you have to wait for indicator candles and things like that, but that's just the overall gist of what I look for. The same concept applies for demand zones. Let's just say, for example, Tesla went to $100. Everyone's going to look at that and be like, oh my God, that's so cheap. Let me buy in. It's going to push the stock up. Now that will create a demand zone right at that area. Now, if price comes back down to that area, we can assume that the same thing will happen. If price of Tesla comes back to 100, people are gonna want to buy it, push it back up. So that's the two things that you want to look for, supply and demand zones as well. The last topic is the 200 EMA. So the 200 EMA, it's the average that price was over a certain amount of time. So it's like you can put it for the 200 EMA, which is one of the most common things that traders use. 200 EMA can also be used as a reaction area. So it can be used as support or resistance depending if price is above or below the 200 EMA. It's something that a lot of traders, I think it's one of the most common indicators. You can look that up, but I believe it's one of the most common indicators. So it's something that a lot of traders have on their charts at all times because it's like a high reaction area. So it's always something good to look at because if price is high above the 200 EMA, you can assume that it has strength, it's on an uptrend. If price is below the 200 EMA, you can assume that the market it's a little bit weaker and it doesn't have as much strength. Please ask questions because I'm here to give y'all the free knowledge that I've accumulated over these past 5 years.
Gabe's Trades.